You have a complaint about that whole process.
No, not that part of it. When I say they never credit the borrower, when the banks receive the balance, they still show the borrower's account as if they never received the balance. When they resell the home, because we're having homes that are covered by FHA and HUD, where they're foreclosing on the home without the so-called FHA letter from the director permitting them to foreclose on the home, which the Uniform Non-Judicial Foreclosure Act requires that they have that FHA letter. They're not having that letter, and they're still foreclosing.
Oh, so what state are you in?
I'm in California, but this is happening throughout the United States.
Yeah, well, I mean, some states are judicial states and some are non-judicial states, so the process can be different in some states.
Well, the Non-Judicial Foreclosure Act applies to both judicial and non-judicial states.
So you're arguing that there are wrongful foreclosures?
No, what I'm actually saying is that when they're foreclosing on these homes, they are still applying for the insurance. But the law, Uniform Commercial Code, requires that when they receive that consideration for that mortgage insurance on that home, or when they resell that home, they must apply that credit to the borrower. In other words, you can't still claim the borrower owes you $800,000 when you just received mortgage insurance for $700,000 and you sold the home for $400,000. You can't still make that claim.
So once I mean, I'm not a lawyer.
No,
I'm in the Office of Public Affairs, which means I only know enough to get me arrested. So as I understand it, if somebody is foreclosed upon and they lose their home, and they're obviously not making mortgage payments any longer, but none are expected of them. They go through the financial ruin of foreclosure, that they're going to repay a mortgage that they submit an insurance claim on. So I don't think that the former borrower, the family, if you will, is being expected to pay a debt that they have failed to pay back on because they are foreclosed upon, and their credit, at least for a time, is ruined, and no doubt they have to go into the rental market because it would be at least 3 years before they could even attempt to get back into an FHA insured mortgage.
No, but I understand that, but we're having lots of people on their credit report that the banks are receiving the insurance, and the credit report still shows them.
Oh, so what you're saying is that their credit record should be expunged of the debt after foreclosure?
No, it should be expunged of the amount that's already been received by the bank as a result of that loan. So when they apply for the insurance,
you mean?
Go ahead.
Well, the borrower has still failed on a contractual obligation.
Yes, they did, but the bank has received compensation.
It would show up in their credit.
Yes, but
so while the bank may have been made whole, the borrower is still identified as a credit risk.
Yes, they may be identified as a credit risk. The foreclosure may still remain on their credit report, but however, the bank has received the payment in regards to that loan, and by law, they must apply that credited amount to that account. They're not doing that.
Well, golly, and now you're beyond me to explain the situation, whether it's in one state or another, if this is a universal requirement of lenders, once they've received a claim payment from FHA, to apply that payment against the, I guess, what would it be against? Would it be against the obligation of the borrower?
The original obligation, because that's what the insurance is for, is to compensate the bank for in case the borrower should default. So once they receive the compensation, it's called value and consideration under the Uniform Code, and it's also, sorry, I got a call coming in and I have to hang up.
Okay.
It's under the Uniform Commercial Code.
Eeon, I don't know how to explain it except that if you would like, I can get you over to people who are much smarter than this than I am, because I'm sorry, it's a bit beyond me to discuss this any further, except that I don't know if it's indeed a standard requirement in the United States that once a claim payment has been made to the lender, that they have to take that claim payment amount and offset the obligation from the borrower in some sort of administrative way on their record. I just don't know if that's true. You say it's true, so I'll take it as gospel. But
with the company that I run, we buy up bad debt from people that many companies charge off. And if we charge off that debt, we are required under the Fair Debt Collections Practice Act to credit that account as being charged off. So we can no longer, technically by law, we can no longer go after that debt because that debt, we've charged it off. But if a debt has been paid, if we receive compensation for a debt, then we can no longer charge it as a debt. We must now credit that account on the credit report showing that debt has been paid.
Well, see, you know much better than I do. I would probably refer you to somebody else in FHA on the insurance division side.
Okay, that will do.
To explain what happens after a claim payment is made to the lender and what requirements there are on the lender to credit whatever claim payment that's been made after the claim has been made, and how they do that and who benefits from it. But if I don't know if that means expunging a debt. I don't know.
Yeah, I don't want to know. We're not talking more so about expungement. We're just talking about if they receive compensation, that they have to notate the borrower's account that they received that compensation on that particular debt, and they're not doing this. And that's. But I don't want to take away your credit. You say that you're not smart. No, you're just not informed on certain things. But as smart, no, you wouldn't have been able to get to where you are if you didn't have some intelligence. So I want to definitely say
So let me give you thank you for saying you're too kind, but let me give you the telephone, the name and a telephone number of somebody in the head of the insurance division at FHA, and you can speak that unique language that only you two can speak.
Okay, I'm ready, and I'll give them a call tomorrow because it's late in the day for you guys.
That's all right. Let me give you his telephone number, and you can call him whenever you'd like.
Okay.
His name is Kevin Stevens, with a V-E-N-S, so Stevens with a V as in Victor.
Okay.
His telephone number, area code 202-402-4317.
Okay, and I thank you again for calling me back, and I do appreciate it. And you definitely have a very good day.
Okie dokie,
Okay?
Okay, bye-bye.
Goodbye. Ladies and gentlemen, this is me saying that you do not have to call Mr. Sullivan, Brian Sullivan. That was him. And as you see, I'm sorry I started the recording late. When I called him, I didn't even think about recording it. I'm sorry I started the recording late. But as you see, he was cordial. He was respectful. He did not try to loud talk me. But here's the thing. This is what all of you need to understand. The borrower makes the monthly payments. The borrower makes the monthly mortgage insurance payments. The borrower is not doing that monthly insurance payment so that they can get a loan at 10% and they're paying that for 20 and 30 years. The borrower is doing that because it's insurance. If there is a flood and you have flood insurance, they do not come and take you and kick you out of your home. What they do is they pay the beneficiary of that insurance policy. You remain in your home and the repairs are made. The same as your car. You have insurance against default. It's there to protect you as well. That's why you pay it. You wouldn't be paying something if only the beneficiary, the bank, benefits. Okay? So this is a line that they spew, but show me the policy. Show me the policy where the borrower agreed to this, where the borrower agreed that they will pay the insurance, and if they default, the bank gets paid and they get kicked out of their home and their credit gets ruined. That's the problem. They are saying this. There is no law that says this. Let's find out. Let's do this so that all of you understand that. And this is, I just pulled up the FHA because this is how I called them. You guys saw that. But let's do this. We're going to look up the legal definition for insurance. So let's get rid of that. Let's do that. Let's do that. And let's do this. 1 second, y'all. Y'all hold on. Legal definition for insurance. One, the legal definition for insurance. Ladies and gentlemen, I'm using up so many resources right now. So voice recognition, the video, the internet, uploading, trying to upload videos. Let's find out what the legal definition for insurance is. A contract in which one party agrees to indemnify another against predefined category of risk in exchange for a premium. Depending on the contract, the insurer may promise to financially protect the insured from loss, damage, or liability stemming from some event. Okay, loss or damage or liability. Ladies and gentlemen, that's liability insurance on your car. You get into an accident, you just only have liability insurance. That pays the other party, but you still get to keep your wrecked car. They don't come and take your car. Mortgage insurance or mortgage default insurance or foreclosure protection insurance is there in case the borrower should default so that it reimburses. I didn't say it. Hold on. Let's go to thank you. Let's show you how mortgage insurance works. This is from their site. This is not from my site. This is what, it's not their site. This is from their email that they sent to DOA. FHA mortgage insurance is insurance to cover that protects the lender against some or most of the losses that can occur when a borrower defaults. Now, he says that HUD resells the home. Sorry, HUD, you can't resell the home. You can only recoup losses. But if you're the insurer, then you're going to have to repay that borrower, because if you recoup your losses, if you resell that home, then you need to, if that borrower has been in that home for 20 years and they just defaulted, then you need to pay them. The borrower has been paying the premiums. Look, the cost of mortgage insurance may include an upfront premium. See, the insurance coverage is purchased and paid for by the borrower. Well, if it's there to protect the lender, why would the borrower be protecting the lender? Well, that's so they can get the loan. Sorry, ladies and gentlemen, don't misunderstand it. The borrower is not getting a loan because Federal Reserve notes are not redeemable in silver, gold, or any other commodity. They receive no backing in anything. This has been the case since 1933. If you may or may not have heard the part, because he did mention 1934, that's where the Federal Housing Administration was created, the Federal Housing Act, 1934. The notes have no value for themselves. Okay, Federal Reserve notes are not backed by anything. So the banks are not lending you anything. They're not lending you nothing. So that's what you all need to understand. If the banks are not lending you anything, pay attention, then they don't get to take the property and collect on the insurance. But hold on. Let's do another thing. Well, let's do legal definition of contract insurance policy in which the insurer, the insurance company, agrees to, for a fee, insurance premium, to pay the insured party all or a portion of the loss suffered by accident or death. Okay, they agree to pay the other party. That doesn't mean in order for them to come and take your house, the insurance company will have to sue you, because technically, the insurance company technically becomes the owner of the property. Well, they can't claim ownership of the property because they have none, because the policy would have to say that they take over ownership of the property, and it doesn't do that. Okay, a contract which one party agrees to indemnify another against a predefined category of risk in exchange for a premium. Okay, 10%. You're going to pay a mortgage premium for 10 years. Now remember, after a certain period of time, you're no longer required to pay for mortgage insurance, because the insurance company or the bank has received the majority of the money. Okay, but you need to understand, it pays them for loss. The insurance company does not come after you. They'd have to file a separate lawsuit. If you don't believe me, look at anybody who's been in a car accident where they were drinking and driving and they had insurance. The insurance company will sue the drunk driver for the fact that it had to pay out the mortgage, but they don't come and take the car. They file a lawsuit. They have to file a lawsuit. Okay? The fact that they filed a lawsuit and they take the house at the same time, they cannot do that. That's what I'm trying to tell you. Now, hold on. This is something else you guys need to understand. We're doing consideration and value. Cooperation, consideration, and fairness are values associated. No. Difference between consideration and value. Consideration for good and value consideration. It's supposed to be for valuable consideration, but we're doing consideration and value. Consideration and value. I didn't even put standard. Yeah, I did put standard. ARD. Oh, I didn't put the D. Okay. Consideration and contract law. Pay attention because we're dealing with a contract. This is what you guys need to understand. This is about the insurance. This is what I'm bringing up. Sorry I didn't mention it to you before, but you've been hearing me talk about consideration and value the whole time. Pay attention. Consideration and contract law is simply the exchange of one thing of value for another. It is one of the 6 elements that must be present for a contract to be enforceable. Consideration must be both legally sufficient and bargained for by the receiving party. Rules of consideration and contract law. The consideration is you made the insurance premiums. The value is they got paid with the insurance. Okay, they cannot have both value and consideration. You make the insurance premium, they get paid by the insurance, and then they get the house? They don't get to have all of that. Okay, we don't want monetary value or consideration. Consideration under American law. Rules of consideration and contract law. Elements, that's the one that was up there. Something of value given by both parties to a contract that induces them to enter into an agreement in exchange for mutual performance. Uniform Commercial Code, value and consideration. This is where you're at. So people, what you're going to do is you're going to type in value and consideration. This is a legal dictionary. This ain't Cornell Law. I said Cornell Law. I don't know what y'all going to this for. I specifically said Cornell Law. That's Cornell Law, legal dictionary. I didn't ask for the legal dictionary. I said Cornell Law. So give me the Cornell.
All right, driver, to Cornell. Okay, one moment, please.
Again, you hear me use the term value and consideration, and what you may have heard me explain to the gentleman is about the Uniform Commercial Code. That specifically says where there is value, there must be consideration. Where there is consideration, there must be value. They go hand in hand. The instrument is issued or transferred for a promise of performance to the extent that the promise has been performed. Now, what is the promise in the so-called insurance portion? Well, the promise has been made that the borrower has paid the insurance premium, and by law it is required. And if you do not pay the insurance premium, the bank pays the insurance premium. Why does the bank pay the insurance premium? Because they can't collect on the insurance if they do not. If the bank collects on the insurance, the bank doesn't get to take the house, collect on the insurance, and if they collect on the insurance, that means they received payment. They had already received the value, the insurance premium. Now they receive the payment, the consideration, and they don't credit the borrower's account, noting that they've received payment on that account. Ladies and gentlemen, that's illegal. They cannot do that. They must credit the borrower's account. This is what I've been shouting. This is what I've been yelling. This is why I keep bringing up, you have mortgage foreclosure protection insurance. I've been saying this since 2011. You have insurance. What you guys didn't hear in that part of the conversation with that gentleman, 4 minutes of it was not there, and I didn't realize I wasn't recording it, is I told him I owned a home that got paid off in 2008, purchased in 2003. Owned a home. Okay? Ladies and gentlemen, it had insurance. I read the insurance policy. It had insurance. I understood that. Should the borrower default? Well, if the borrower defaults, sorry, you don't get to sit up here and take my home. Oh, God, no. This is mine. You got your insurance payment. It's got insurance. You need to go get the insurance. It's not that you don't understand. It's that they are sitting up here pretending that they get to collect the insurance, get to sell the home, and you are the only one who's out. Ladies and gentlemen, you guys have got to stop letting this happen. It's happening because you guys are allowing this to happen. An instrument is issued or transferred as payment of or a security for the antecedent claim against any person, whether or not the claim is due. See, value and consideration. This is where the insurance comes in, because we're dealing with value and consideration. Those of you who don't understand value and consideration, y'all got some reading to do. Y'all got some understanding to get. Some understanding, because y'all need an understanding, okay? Consideration means any consideration sufficient to support a simple contract. The consideration is they receive the insurance payment. The drawer or maker of the instrument has a defense if the instrument is issued without consideration. If an instrument is issued for a promise of performance, the issuer has a defense to the extent that the performance of the promise is due. The promise is due that you have insurance and you don't receive the benefit of your making those insurance premiums. And the promise has not been performed. The insurance is there to protect you. He says the insurance is only there to protect the lender. Well, the fact that you have insurance, it's there to protect you. Homeowner's insurance is there to protect the home owner. Homeowner's insurance. Mortgage insurance is there to protect the parties involved in the mortgage contract. If an instrument is issued for value as stated in subsection A, the instrument is also issued for consideration. Okay? The holder in due course. This is where you get the term holder in due course, ladies and gentlemen. It's from the UCC, section 3-302. Value and consideration, 3-303. This is why you hear me talking about this. No, I don't have to study this stuff every day. It just stays up here in my head, okay? Value and consideration. You will hear me say that phrase a lot because that's the way it's worded right here. My mind just retains it, okay? That's all it does. So y'all leave me alone, wondering how I know all this book, okay? So thank you, ladies and gentlemen, for listening to this call with your favorite neighborhood FHA press officer. Please understand, Mr. Sullivan, he's a government official. He has no protections as far as being told the call is being recorded because he is a public official. Okay? They have no privacy rights. So, but although, of course, you know, I've made mention to them that I was recording the call. That's why I left him a voice message that was recorded. He left me a recorded voice message, and I acknowledged to him, thank you for calling me back. Thank you for leaving the recorded message. So we both recognize the calls are being recorded. So, ladies and gentlemen, there is Mr. Sullivan. Y'all have a good day. Uh-oh. Y'all have a good day. Uh-oh. Y'all have a good day. Uh-oh.
Eeon! Hi, Eeon!
Y'all have a good day. Uh-oh. Y'all have a good day. Uh-oh. Uh-oh. Uh-oh.
Uh-oh!
And I'll talk to you all later.
Goodbye!